Thanks for your company this Friday, the 9th of October for the weekly wrap. I'm Jessica Amir, a market analyst with Bell Direct. Well, the market rocketed up 5.4% from Monday to Thursday. That's its best gain since the 10th of April, bolstered by budget stimulus, the RBA hinting of a further rate cut, and US President Donald Trump encouraging the approval of a $1,200 payout to Americans. So, on economic revival hopes, all local sectors rallied this week. Energy up the most 8%, its best gain in about 26 weeks after the oil price rose over 9%, supported by the falling US dollar and improving global outlook, and the US Gulf shutting off 29% of oil output ahead of a hurricane. Financials also did well, up about 8%, their best gain in 20 weeks, thanks to budgetary support for individuals, pensioners and businesses. With that in mind, big movers included Zip up 22%, Virgin Money up 18%. On the other side, we saw Viva Energy fall the most, 11%. They're the owner of Shell in Australia and supply half of Victoria's petrol, and they're calling on the government to provide support or they risk the closure of their Geelong plant, which has been hit by waning demand due to Victoria's lockdowns. Now, as for the federal budget's $41 billion extra economic stimulus for markets, I guess there's three key takeaways. Firstly, we know the government will provide further stimulus, but this budget paved out tax cuts and offsets of up to $2,745 for individuals. For employers, they'll be paid $200 per week for hiring unemployed 16 to 29-year-olds and be paid $100 per week for hiring 30 to 35-year-olds. Businesses also encouraged to splurge on big ticket items to reap tax deductions as long as they're earning under $5 billion per year. Secondly, big takeaway for the budget, economic growth is now expected to only pull back 1.5% in FY21. That's actually rosier than what the RBA forecasts, as the budget accounts for a stronger rebound in household spending next year. And GDP is also expected to recover to 4.75%, with unemployment normalising in the year 2022. And the third big takeaway for the budget, government debt has swelled to almost $214 billion. That's 11% of GDP, the worst deficit since World War II. And given government stimulus is focused on getting unemployment under 6%, further stimulus will come and push debt to $900 billion, or 23% of GDP by 2022. That's a lot, but a major credit agency says it's manageable and restamped Australia with a AAA rating. So these three budget measures, on top of the RBA keeping rates low and hinting of a potential another cut, all support longer-term share market growth. So when it comes to where to invest, there are three key themes to consider: infrastructure, retail and banking. The first is infrastructure. Given the government pledged an extra $3 billion, taking total infrastructure spending to $14 billion since COVID, yearly construction material industry revenues are estimated to grow to by 80 to $250 million. Now, this could specifically lift earnings by 1 to 3% for Adelaide Brighton and by 0.5% to 1.4% for Boral. So if you're looking for a stock to watch, Boral has a footprint on the East Coast where the majority of government pipeline work is focused, but it will need to win government contracts first. We already know infrastructure was going to get a big kick, so could ABC and BLD's prices already factor in these brighter outlooks? Well, Citi sees more upside in Boral and has it as a buy with a $5.30 target. BLD also a UBS buy, $4.30 target. For ABC, most brokers have it as a hold. Morgan Stanley, the outlier, with ABC as a buy, $3.20 target. Now, the second theme to consider is retail. It's likely to cool from its COVID high as superannuation withdrawals have already been spent, but personal income tax cuts, extra pensioner payments could provide $3 to $4 billion a quarter extra to household income. Plus, JobMaker program could support retailers' cash flow if they employ more staff, and their earnings could lift almost 0.9%. Sprinkle in the tax deductions and retail cash flows could grow 5 to 10%, and that's according to Citi. But given retail is cooling, it's probably worth looking at stocks that are operating on cheaper price to earnings ratios as they could benefit the most. Citi likes Coles and Super Retail the most and also has buy ratings on Baby Bunting, Beacon Lighting, Harvey Norman, Metcash, and is seeing the most annual growth in BBN, that's Baby Bunting. UBS's picks are Breville, Bapcor, Collins Foods, and also HVN and Premier Investments. Bell Potter likes Afterpay, BWX, Temple and Webster, Accent, City Chic, and PMV as well. And the final and third theme is banking. It's likely to indirectly benefit from wage subsidies, tax offsets, and tax write-offs, specifically from the SME mid to smaller corporates. Bell Potter's top pick because of this is Macquarie. Among big banks, ANZ and CBA are Bell's faves, and ANZ is also backed by UBS, so keep that in mind. For the smaller banks, Suncorp is the star, also backed by Bells and UBS. From all of us here at Bell Direct, have a happy and safe weekend. Thanks for your company. Bye for now.